My name's Ethan Braid. Today we're going to take an objective look at the Magnificent Seven stocks so that you can decide for yourself, are these stocks in a bubble? This is going to be a fast and simple exercise. We're going to compare these stocks to the entire stock market, the S&P 500, and we're going to compare these stocks to our economy, the GDP of the nation. And once we're done with this exercise, I think you will find it not only to be eye-opening, but it will help you make a quick determination of whether or not you think these stocks are in a bubble. When we analyze the total value by market cap of the Magnificent Seven stocks relative to our entire economy, GDP, the number is an astounding 52%. The Magnificent Seven stocks are 52% of GDP when measured by market cap. They are also 32% of the S&P 500 when you compare the market cap of the Magnificent Seven to the S&P 500 market cap. Apple alone is 12% market cap to GDP, and this may be why Warren Buffett recently sold half of his position in Apple stock. Warren Buffett has long said that market cap to GDP is one of his favorite simplified valuation measures to indicate whether or not the stock market is expensive. Looking at the total sales of the Magnificent Seven, we see that the group only produces $1.8 trillion of total sales on a $28+ trillion economy, representing only 6% sales to GDP. Quite a small number when we consider that this group of stocks is 52% market cap to GDP and 1/3 of the market cap of the S&P 500. Yet another indication that this group of stocks is very expensive. The third leg of our stool for analytical purposes will be the fundamentals. And the fundamentals tell us that this group of stocks is very expensive. The average PE for this group as a whole is 40 times earnings, and the group pays 0.42% dividend yield if you bought all of them equally weighted. Compared to the S&P 500, which is 26 times earnings and a 1.28% dividend yield, the Magnificent Seven group of stocks is over 1.5 times more expensive, and you only get 1/3 of the cash flow if you own these companies. So are these stocks in a bubble? I think the answer definitively is yes. Their valuations, when you consider market cap to GDP, are the most concentrated that we've ever seen in the history of the United States. This is worse than the 1929 bubble or the year 2000 tech bubble. We have two stocks, Apple and Microsoft, representing over 20% market cap to GDP. If you think back to the last major bubble, the 2000 tech bubble, you had a handful of companies like Cisco, General Electric, and Intel that were in the $500 billion range market cap on a $10 trillion economy. So they were only roughly 5% market cap to GDP, and that was a bubble. So now we have stocks that are over 10% market cap to GDP. Again, this is the most concentration that we've ever seen. And when we think that the group is 52% of market cap to GDP, if they were to double anytime soon, they would overtake the economy on a market cap to GDP basis. They would be worth more than 100% of GDP. That's wild stuff. Now, how will this bubble burst? Nobody knows. I don't know, and I don't think anybody else does either. And it could be that these stocks never go down in value in any major way. But I think your growth prospects going forward are very limited at this point for the simple numbers that I just cited. If these stocks were to double or even triple anytime soon, they will be over 100% market cap to GDP. And when we think back to the sales are only 6% of GDP. So we're paying a lot of money for this growth. I think that the best returns are behind these stocks. Again, it doesn't mean that they're going to roll over and go down in a significant way, and it doesn't mean that you can't make money on them going forward. But I think that your growth opportunity is going to be much more muted. Remember, the bulk of the return from these companies comes from the shares going up in value, since your dividend cash flow is so limited on these stocks. Now, for those of you watching this video who own the stocks, don't get mad and hit the dislike button. I'm just being objective. I'm telling you the truth. And remember, the truth is worth its weight in gold. The truth is hard to find. So just remember that. Don't get upset because I'm raining on the parade of the Magnificent Seven stocks. I hope they go higher. I'm just trying to be objective and paint the picture that these stocks are the most concentrated we have ever seen in the history of the stock market, and the returns are likely to be a lot less in the future, and possibly negative. Just take a look at GE, Intel, Cisco, and a few others that were very, very concentrated stocks 25 years ago, and see how those investments have fared over the last 25 years. I know they're not the same companies, but the idea is the same. When you get this much concentration, your future return prospects are a lot more limited. I hope this video was helpful. I hope it gets you thinking, helps you better analyze your investments, and overall improve your family's financial plan.